No. I'm just starting the recording now. Are you able? Let me share the screen. Are you able to see the screen? Yes. So we're still dealing with this question for show black. Okay. We got the gross profit. Right now, we need to start the statement of profit or loss, where we calculate the net profit. Remember, gross profit is the profit after you subtract the cost of goods sold or the cost of goods manufactured. The net profit is the profit that you get after you deduct the operational expenses, the selling expenses, distribution expenses, admin expenses, the finance costs, tax costs. Once you deduct all of those, then you get your net profit. So now we have to start with our statement of profit or loss. And as I said, the first thing that you're going to look for once you start the statement of profit or loss is you're going to add any forms of income to the gross profit. Okay, let me just make this more visible. You're going to look for any form of income that you've been given within the equation to get the gross profit. Let's see, this depreciation stuff for this. Okay, yeah. So basically, we look for any forms of income that we can add to the gross profit. We're going to check here. Okay, yes, we have this one here. Discount received. Colleagues, what is discount received and what is discount allowed? Anybody to give it a try? Yes. Yes. Your customer asks for a discount and you give them. Yes. So discount allowed is going to be treated like a loss or an expense. And then discount received, yes. So that is taken as a form of saving, right? You have kept some money. So the discount received is the one that you're going to add to the gross profit. Sorry, let me just do this and that. So that we make life easy. Just hold on, colleagues. Hold on. Yes. So first thing that you need to add to the gross profit is discount received. I don't know why this thing has frozen. Let me close it and open it. Yes. So discount received from our question here, we can see here. Okay, we have got discount allowed and received. One amount is on the debit side, 80,000. One amount is on the credit side, 100,000. So which amount are we picking between the two? 100,000, yes, because remember there were these three zeros on top here, so it's 100,000 kwacha, yes. 100,000. Why are we choosing it? The one on the credit side? Okay, remember. Yes? Since it's an income to the company, remember, according to the double entry rules, income and revenue increase with credit. Expenses increase with debit. So discount allowed will be on the debit side. Okay, because it's a loss, you're losing money, so that loss is treated like an expense. So on the debit side is the discount allowed. The discount received it will be the one on the credit side. Okay, so we're going to pick this 100,000. Okay, so if you are given a situation like this, just remember, if it's on the credit side, it's discount received. Okay, if it's on the debit side, it's discount allowed. Are we okay with that, colleagues? So we include it here, 100,000. There is no other form of income. Okay, so you add 4,662,000 plus 100,000. Okay, 4,762,000. So if you see anything written as received or receivable, remember you add it here. Received or receivable, then you're going to add it. Okay, colleagues? If you see commission received, rent received, rent receivable, commission receivable, just know that's income. Okay, discount received, all of those you add. Okay, colleagues? And if there is a decrease in, yes, and if there is a decrease in the allowance for irrecoverable debts or provision for irrecoverable debts, if there is a decrease, then you also add. to the gross profit. Okay, so please jot those down. If it's got the word received or receivable, you add to the gross profit. If the provision for recoverable debts reduces, okay, here what are they calling it? Allowance for doubtful debts, yes. If the allowance for doubtful debts, also called provision for irrecoverable debts, provision for doubtful debts, if there is a decrease in this allowance for doubtful debts, okay, then that decrease, you get the decrease and you add it to the gross profit. I hope that is very clear. So the next thing is just to add expenses. We have depreciation here also. Although I calculated it on there, but we also have depreciation here. Okay, so we also need to calculate depreciation. Okay, so depreciation should be provided as follows: buildings 2% on cost per annum, warehouse 15% on cost per annum, motor vehicles 25% on cost per annum. So this is the straight line method of depreciation. Colleagues, depreciation is the loss in value of an asset. Okay? As you use, if your asset is a car, the more you drive it, wear and tear. If you buy a car today at 20,000, you cannot sell it 10 years later at 20,000. No, because it would have been wear and tear. It would have undergone wear and tear. Okay? So depreciation is the loss in the value of an asset. So there are two ways of calculating there are more than two ways, but the most common you see, the two methods is the reducing balance method and the straight line method. So in this question here, we have the straight line method. The difference between the two, colleagues, okay, the reducing balance method, as years go by, the depreciation expense will be reducing, okay? That's why I say reducing balance method. As the years are going, the depreciation expense will also be reduced. The straight line method, the depreciation expense is the same every year, okay? Need to be the same every year. So the straight line method is very easy, okay? As I've told us here, a building's 2% on cost. You go to the value of buildings. Buildings that cost 8,300,000. Because remember, there are three zeros on top, so 8,300,000. Let's get our calculators. What's 2% of 8,300,000? Provision for depreciation or accumulated. Yes, what's 2% of 8,300,000? 166,000 kwacha. So let me just illustrate how depreciation works. Okay. So with the depreciation, all right, we've calculated 166,000, right? 106,666,000. So this is how depreciation works. Okay, that year, this is the general entry for depreciation. Okay, you are going to debit depreciation expense 166,000. Okay, on the depreciation expense account, you put here 166,000. Okay, then you're going to credit accumulated depreciation, also called provision for depreciation. Okay, accumulated. Oh, ha, I don't know why I was writing 1 million. Hey, sheesh, thank you, sir. Disadvantages of late night classes. Okay, yeah. So here I have to put 166,000. Okay, so we're going to also credit accumulated depreciation 166,000. Okay, so let me just check on the question if we've got an amount for the provision for depreciation. So it's for buildings, right? That we are calculating. Buildings at cost is accumulated depreciation buildings 1,020,000. Okay. So this amount is already existing here. 1 million or is 1,020,000. Yes, this amount is already existing here. And then we are bringing in also this 166,000 also here. So when the year ends, you close the depreciation expense account, you credit it here, 166,000. Okay. Here we're taking it to the statement of profit or loss. That's why I've put PL here, statement of profit or loss. It's a credit here. Then the statement of profit or loss, sometimes it can also be taken as a T account also. It's going this amount to appear on the debit side of the statement of profit or loss, meaning it's just going to be amongst the expenses. Okay. Then on the accumulated depreciation, you get the total amount 1,020,000 plus 166,000. Mhm. Yes. So this is the amount you're going to see on the balance sheet. Okay. On the balance sheet, I already made a balance sheet. Yes. Have you seen? And accumulated depreciation 1,186,000. Okay. This amount here is taken to the balance sheet. Okay. So this is the straight line method for just for so that we get a full understanding. We'll call this year one. In the next year again, since it's a straight line method, so the depreciation expense will always be the same. So in this next year, you're still going to do this journal entry: debit depreciation expense, credit accumulated depreciation expense. You debit here again 166, and on the accumulated depreciation expense in the next year, this 1,186,000 will be opening balance. Okay, 1,186. This is going to be the opening balance. Okay. Then, since the depreciation charge is still the same and we've credited accumulated depreciation, the same amount, so again, you bring it here and you add, you get the accumulated depreciation. So for that year's balance sheet, whatever amount you get when you add this, it will appear on the other year's balance sheet. Okay. So this is how the depreciation works. I'm not mistaken, this is the amount 1,352,000. This will be in the next, after this year, then the next year's, and the process will continue until the cost eventually reaches zero or a very small amount, which you can even now give away the item for. So, so the thing that you just must remember from everything I was illustrating to you is that as the years go by, accumulated depreciation increases and the value of the asset goes down. Okay, colleagues? As the years go by, accumulated depreciation increases while the value of the asset goes down. Okay? That's what's happening here. Okay? Yes. Any questions? Because depreciation is also a topic on itself. The only difference is in that topic now, depreciation is going to start in the middle of the year. So you need to calculate, okay, the depreciation expense for this amount of the year. Usually for financial statements, they'll assume everything is bought on the first, and then they'll give a depreciation charge. Okay? Yes. So we've got depreciation for buildings. Next is to get depreciation for warehouse, 15% on cost. So you go to warehouse at cost, 1,800,000. What is 15% of 1,800,000? 15% of 1,800,000. What is 15% of 1,800,000? Okay. 270,000. Yes. Depreciation motor vehicles, they told us is 25% on cost. So the cost of motor vehicles, 1,680,000. 25% of that, 420,000. Okay, that's how we get our depreciation expenses. Any questions? Discount allowed. We saw it on our information here. Debit side here, 80,000. Allowance for doubtful debts. So as I said, in the question, the wording here it said allowance for doubtful debts increased to 30,000. Okay. So now when I did my tabulations and we said okay, it increases from this amount here, allowance for doubtful debts 18,000. If we take it that increases from 18 to 30,000, when you do it that way and you make your balance sheet, it's not going to balance. So as I said, there was a typing error here. It should have been increased by 30,000. Increased by, not to, but by. And when you take it this way, you are going to see that everything is going to balance. Okay, so it was basically just a typing error by whoever was typing. Okay. So as I said, allowance for doubtful debts, when there's an increase, it means you're expecting not to receive 30,000. This increase of 30,000 is telling us that we might not receive 30,000 from the people who are owing us money. So since we might not receive any more money, that's like a loss to the company. So this 30,000 here will be treated as an expense. Okay. So here we're going to say allowance for doubtful debts increase 30,000. If there is a decrease, add it to the gross profit. Any questions? Mm-hmm. Um, those are the ones that you mostly see. I've never seen a question where they bring the is it units of output method. I haven't seen a question. But in case during the course of the year you learn about it, I will teach you about it. I'll teach you the other methods. But for first year, you'll be dealing mostly with reducing balance method and straight line method. Even in your income statement questions, you find it's either reducing or straight line method. Yes? Which same question? Oh, I'm recording. I'm recording. Oh, the trading account one. Oh, yes, there is also a video. There is also a video. Okay, colleagues, remember all the videos in the group. Just look through. I would sort. I also help sort them out. But there is a video for the trading account part. Okay. Last week Tuesday. Last week Tuesday. So that should have been on the. Just try to backtrack with the calendar and so when I'm also done with this lesson, I'll post the first one and this second one so that you have them compiled so that you can see them together. Even for the assignment question, there are also three videos for that one, so I'll put them together. Okay, okay. Yes. So allowance for doubtful debts or provision for doubtful debts, colleagues. Whenever you see an increase, it just means you expect not to receive more money. The loss is getting bigger, basically. If you see a decrease, then you're getting some money, and that money you take it as a gain, okay, and you add it to your gross profit. Now, these are hours for doubtful debts. As I said, sometimes the people might pay you back, okay. So if the people pay you back, you're going to do some adjustments, okay, so that the figure changes, okay. That's the difference with allowance for doubtful debts and bad debts or bad debts written off. Bad debt written off, once you've stated that figure, you are certain with a 95% confidence level. Let's add some statistics here. You're certain with a 95% confidence level that you are not receiving that money. Maybe the person died, so his business has closed. Okay, you might not receive the money. Maybe a business has gone bankrupt. Limited liability. Colleagues, remember limited liability? his, his business has gone bankrupt. So you're not going to go to his house to try to recoup from his personal assets. Okay. Because his business is bankrupt. So that's where his liability ends there with the business. So bad debts, or sometimes it's called bad debts, or it's other times it's called, whenever say debts are to be written off. This one, yeah, with a 95% confidence in level saying you won't get that money. Allowance for doubtful debts, yeah, with I'll say 60% confidence level, okay, because it's just an estimation. You just estimate. Yes. Okay. Salaries and wages. So there was information they gave us about salaries and wages. It says salaries and wages were owing 190,000 and 70,000 paid in advance. Now, for those who are there in the first class, when we looked at this, what did we say about these two? Which one is an accrued expense and which one is a prepaid expense? And how do we treat each of them? Madam Betha, okay, yes, Y- yes. Yes. What is an accrued expense and what is a prepaid expense? And how do we treat them? Partial. Okay. Mhm. Ah. Mhm. Yes. You haven't paid for it and it just keeps building up. Okay. Just think of it maybe in terms of rent. The month comes, you haven't paid rent, you'll be owing rent. Another month passes, haven't paid rent, that rent amount will keep on building. That becomes now an accrued expense. Okay. Versus where you pay rent 4 months in advance, 5 months in advance, that's a prepaid expense. So please pay attention on this part. Okay, because the next time, the next question is you trying it by yourself. And obviously there will be an accrued expense and there will be a prepaid expense. So please pay attention to this part. Accrued expenses. On the statement of profit or loss, you add on the balance sheet, you include it as a current liability. This accrued expense of 190,000 on the statement of profit or loss, we are going to add. As you can see here in this tabulation, we are saying plus 190,000. We're adding it to the wages expense, salaries and wages expense. Okay. Then on the balance sheet, under current liabilities, okay, here's the same value, accrue salaries and wages, include it as a current liability. Are we okay with that point? Remember, when this concept comes, I remember who is in class. So when this concept comes, get ready to be cold. Okay. Then prepayments. Okay. On the statement of profit or loss, subtract, and in the balance sheet, include it under current assets. Okay. On the statement of profit or loss, the prepayment you subtract. Okay, since you've paid for something in advance, so from the total expense, you deduct what you've paid already for in advance. So in the statement of profit or loss, where is that? Statement of profit or loss. Subtract. See, minus 70,000. In the balance sheet, include it with the current assets. Okay, so this 70,000 is included with the prepayments here. Okay, this is the prepayment for the salaries and wages. This is the prepayment for distribution expenses. Okay, so I hope that is clear, colleagues. Even here, distribution expenses, you have 60,000 prepaid, 120,000 not paid. So this 60,000 prepayment, this 120,000 accrual. So you subtract this 60,000 in the statement of profit or loss, as we saw. You subtract the 60,000. Oh, I've seen minus 60,000 here, distribution expenses, minus 60,000. Okay. And the accrual, you're adding it, 120,000. So this 120,000, which is an accrual, on the balance sheet, where are we going to find it, colleagues? Where will we find the accrual of 120,000 on the balance sheet? Let's see who's dozing and who isn't dozing. Yes, Madam, Mr. Joshua, this 120,000 accrual, on which section of the balance sheet will we find it? This accrual of 120,000, which section of the balance sheet will we find it? Will it be under current assets, capital, current liabilities? Thank you, madam. Current liabilities, yes. Although I wanted Mr. Joshua to answer. But thank you, madam. Yes, we'll find it under current liabilities. And then this 60,000 prepayment, where are we going to find it? Yes. So please remember that, colleagues, because every financial statement question, you are going to meet one of these. Maybe the both of them, or you might meet one. Okay. You always, so just if you remember these concepts, you'll be okay. Yes. Then, even here, we've got interest of 50,000 that is all. So we have another accrual. So, meaning, since it's an accrued expense, we're going to add it to the interest expense in the statement of profit or loss. Interest 50,000 plus another 50,000, this one which is owing. And then on the balance sheet, under current liabilities, you'll find it again, interest owing, 50,000. Then here's another accrual. Okay. Credit purchases totaling 18,000. We are owing. Okay. So you add it to the purchases expense in the trading account. Okay. Which was done in video one. And this 18,000, since we are owing, balance sheet, you include it here, the credit purchases, 18,000. Yes. The other expenses, carriage outwards. Do we remember what carriage outwards is? Not Mr. Emmanuel. Let me see the others. Mr. Emmanuel, you're the one who told us last time. Yes, colleagues. What is carriage outwards? Madam Yvonne, Madam Beth, Mr. Frederick, Mr. Joshua, Madam Florence, Madam Caroline. Okay, Mr. Emmanuel, please remind us. Yes. The trans if you deliver goods to your customers, okay, fuel is not free and cars do not run minus fuel. Okay. And let's say even you don't even charge them any transportation delivery charge. Okay. That transportation cost that falls on you. Okay. And maybe in case if you charge your customers and all that money that you charge them goes to the fuel expenses, you still record it as an expense in your statement of profit or loss. Because you're not keeping that money, you're using that money for the transportation operations. So carriage outwards when you are delivering your goods to your customer. Then carriage inwards if your supplier is delivering goods to you and they've given you a charge. Yes. Then let's see. The last one, trade balance is written off. This 6,000. Okay, this is the money we know we are not going to get. Okay, we are not going to get that amount of money. So when you total up your operational expenses, you get total of 4,552,000. And then to get your net profit, it's your gross profit minus your operational expenses, and you get 210,000.